Okay, well, good day, everybody. Derek Lobo here at your service. Today, we're talking about stateside returns and how you make a apartment development investment in the United States. We structure joint ventures with developers in Canada and the U.S. And I suppose that the process that we use for Canada and the U.S. is relatively the same. You go through the same due diligence and so on. But we're going to walk through a thesis here today that we have and our philosophy on investing in the United States. Okay? These are difficult times. Returns are thin in apartment development. But when we look to the US, it's a huge country, 50 states. You can't just say the US. We segmented the United States and we think we came up with a winning strategy, and we have written our own money into checks. That's a good signal as to the commitment of the person, putting the deal together. So, Rod, let's proceed. We're talking about investments stateside in the U.S. My co-host, co-pilot here, Dave Price. Dave is the one. Dave and I are the guys who find the deals. Okay, do the initial contact with the developer, talk to our investor, and then we've got a whole team of people that does the due diligence and the research work required on the developer, on the site, on the returns, and that sort of thing. Okay, next slide. So, as a company, we do webinars and we do seminars. We are commercial real estate brokers. We raise equity. We provide debt financing for new apartment construction, takeout financing on new apartment construction. We raise equity, but we also see ourselves as educators. We constantly want to be providing the marketplace what we call thought leadership. And interestingly enough, I'm not sure anybody has ever done a session titled, "What is rent?" Rent is the blood, it's the lifeblood of our business, but what makes up rent? How do you charge it? And there are different kinds of rent, right? So we're going to do a seminar June 23rd, which I think is going to have really wide appeal. And we've got a real expert from the United States named Brian Pierce. And Brian is going to do a session with us on rent, how you set it, how you raise it, how you lower it, and discounts and so on. Okay. We also have our annual conference. I think this is year 16 for us. It's a full day conference as part of the Toronto Real Estate Forum, December 1st. And we focus strictly on the topic of apartment development. And we also touch on affordable housing of apartment development, but it's just focused on that. It's not an overall apartment conference. We're talking here to apartment developers, and that's a good part of our business, here at Rock Advisors. Yep. We also, I am the president of the National Apartment Council. This is the industry association for apartment developers. The way the home builders have an association, the way the realtors have an association, there was no association for apartment developers, private apartment developers. We went and we set it up. This is the date of our annual conference. It'll be the largest gathering of apartment developers in Canadian history. We've organized the industry and we are lobbying the government for beneficial legislation to cause the building of the apartments that we need in Canada. Okay, so this is open to all apartment developers. There's a QR code there, and it's September 21 and 22. It's a big deal, and if you're a developer, you should be there. Questions and answers, put them in the chat box. We'll try and get to them, during the session today. Okay. So the first part of it starts with really, and this is our team here. These are the people who work at Rock Advisors and form the due diligence team that we do when we invest in an apartment developer. And I'm going to give you the answer to the entire seminar right now. 90% of our decision as to who we invest with, okay, and where we invest, who we invest with more than anything else, is the character of the developer. And the character of the developer doesn't show up in the financial statements. It doesn't show up in the investment documents. It shows up when you spend time with the developer. So when we go down there, we spend time with the developer. We eat with them. We sometimes drink with them. We're there early in the morning. We're there late at night. We're on the construction site. But we need to know who is the guy at the top of the pyramid, who's his senior team. And that's why we take a large group of people and we all meet with our peers and really evaluate them. So you can see us, we're having dinner, we're flying down with them, in their plane, we're at the construction site. And this gives us a really good indication of the developer's ability, their team, but really what we're after is that nebulous thing called character. There's no way you clearly articulate it, but if the location makes sense, the demographics make sense, the returns on paper make sense, their history makes sense, yeah, that's all well and good, and you have to tick off those boxes. But at the end of the day, if something goes wrong, and it often does in development, what is the character of the developer? I'll talk a little bit more about that, but it's our experienced due diligence team is going down and spending time with their team, and then we're making a decision. Do we want to write a check with our money into that deal? So we've got a process here that we go through. It's not particularly difficult. It takes a long time. And if we don't get good results throughout the process, then we're not going to invest, right? So usually starts with Dave and Derek. Yep, no, go back. Usually starts with Dave and Derek, just finding a developer through our relationships and getting to know them, on Zoom and just through phone calls and just through talking to them. Then the key is we fly down to the U.S. and we spend time with them. Typically, we'll spend 2 days with them, meet their entire team, go to the site, go to their old projects, go to their newer projects, see how they've evolved, see how they've developed. And then once all that's in place, we negotiate the deal, we structure the deal, and we become owners of the property with the developer. So Canadians are the largest investors in the United States. Next slide. And the question we ask is, have you ever invested in the US before? Well, many people have houses in Florida or a condo in Florida, something like that. And there's an organized methodology just through MLS and, real estate agents in Florida who specialize in selling houses to snowbirds and things like that. But when it came to finding apartment deals, there was no formal process. There was no MLS. There was no normal pipeline and things like that. And, we don't think of it as United States. We think of it as 50 countries, 50 small countries, or like 10 provinces. Ontario is not the same as Alberta, and New York is not the same as California, right? Or Indiana or Florida. So you've got to look at all these, very, 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 very carefully and individually. So there's too many states to look at with 50 states. I'm going to go through our process of how we eliminated states and then how we looked for safety. But I just want to say that Canadians are by far the single largest investors in U.S. real estate after U.S. investors, right? So therefore, we're already there, but what we want to give you is a clear pathway that if you like the apartment business and you want to get apartment development returns, we think that we've done the homework, we've zeroed in on where the development should be and zeroed in on the type of developer that you want to invest in, okay? Next slide. So, we've got to find investors, and we're investors ourselves. We're talking here about joint ventures, okay? We're talking here about people who know the apartment business. We're not talking about investors per se, and I'll go through that in a minute as to who our joint venture partners are. We have a thesis on the Midwestern United States, and we spent a lot of time there. We've interviewed a lot of developers there. So we had to zero in on a place. We zeroed in on the Midwest. We wound up investing in the state of Indiana, but we also see opportunities in the states, around that area, around the Three Rivers. We've got to vet the developer. We've got to find the investment project, and then we just got to, vet the project, go through the steps of due diligence, and then you get down to, doing the deal. So typically, our partners are successful Canadian private apartment developers already. So these are people that we already have a relationship with. We're in the apartment business. We've been doing this for 4 decades, and we have our relationships with people who are apartment developers. They understand the business. They want to be in this business south of the border. They know how to swing a hammer, but they're tired of swinging it. So typically our investors are generation 2. Gen 1 developers need their money in Canada to build whatever they're building. We're talking about people who are saying, look, we've made a lot of money. We'd like to get some diversification. Sometimes they're concerned about Gen 3. Sometimes Gen 3 can't swing a hammer, but they've got an MBA and they know how to invest. So sometimes it's a combination of Gen 2 and Gen 3. It's usually high net worth people. This is a capital intensive business. It's tens of millions of dollars that have to get invested per deal. So we're talking about, development families, development clients who understand the business and who have liquid assets of maybe $100 million to write the size of check that we need. Typically, we look for safety first clauses whereby the U.S. developer who's building the deal would lose money before we ever lost any money, right? And we find that our clients, after they know us and want us to do the due diligence and be the trustworthy guide that finds the deal, vets the deal, and then brings them a fully baked cake with all the due diligence done so they can make a good decision. Typically, our partners are big guys, the Gen 2 and Gen 3 person, and they like to have control. So they want to be the single investor, and that's typically how deals have gone, right? And so it's just ready to transition from, it's for people who are wealthy, who want to transition from a development role to a more hands-off strategic role. And then we want to choose projects that are very safe. And we find, and I'm going to show you the cost in a minute, but we want to go to the markets where the price of construction and everything is lower, as well as the rents are lower, just de-risking the entire project. Okay. So this is a tough question to answer. Where are we in the real estate cycle? Well, the world is confusing right now. A lot of people don't know where we are, but I think that this is the normal cycle of a real estate cycle, and that cycle can vary in years, but it all depends on where you are in the country. In Ontario right now, I think people would say that we're at the bottom where there's some fear, panic, and despair, but yet the people in Alberta, there's optimism, right? So that same thing applies to the United States. It's not one country. I'm saying each state is as complex as every province we have, maybe more so, and there's 50 of them. So you can't do homework on 50 states. So you need to find a way to eliminate or to choose states that will be, give you the kind of returns you want, the kind of developer you want, and also the risk profile that you want. We're going to talk a lot about risk today. So the US is huge. We were looking for places that had less risk and more upside. Those are our key structures, right? So the other reason that people want to go to the United States is that overall it's a freer market. Okay, in Canada, 8 out of our 10 provinces have rent controls, and rent controls are a damper on investment, and it's a damper on foreign investment or out-of-state investment coming in. So we are highly regulated in the U.S. They are less regulated in the U.S. We have more taxes in Canada. I know I don't need to talk about Canadian tax policy and how brutal it is, but overall, the lower taxes in the U.S. on many, many things. I'm not talking about personal income tax. I'm talking about the taxes on product, on development charges, things like that are generally lower. And in Canada, they're higher and oftentimes much higher. So you have more of a free enterprise system, but that varies from state to state. California is very different than Indianapolis. Okay, next slide. So we have a U.S. Midwestern thesis, okay? And this is what led us to go to the state of Indiana. We met several companies there. And I'd say the most common, if you're looking at the Midwest, like Indiana, the most common province or the most similar province would probably be Alberta for its, not geographically speaking or economy speaking, but its lack of regulation and things like that. But in Canada, when we go to Alberta, which we think is maybe the best place in Canada to invest right now, we're not finding developers that have, let's say, an institutional setup. In Alberta, most of the developers are still Gen 1 guys, kind of wildcat guys. They haven't built up companies that function like, financial organizations with transparency, with practices, with investment reporting and things like that. But in the US, just given that it's a more, the apartment development industry is much more advanced there, much more sophisticated. You find these type of companies that are built for outside joint venture partners or outside investments. So there's a difference between Canada and the USA just in the type of developer. Our developer is more of a typically, I would define Canadian apartment developers as tentpole companies. You know, there's one main guy running the whole thing, and he's that brave, rugged entrepreneur. In the US, they start that way, but they morph into organizations that have life after the original developer is gone. And we're making long-term investments here in apartments. What happens if the main guy gets hit by a bus? We're looking at the rest of the team, the infrastructure of the company, and so on. So, Rod, let's just show some colors here. Okay, so I think that because our investments are typically with private apartment developers, okay, we think, and our joint venture partners are private. We think, and this is my thesis, and you can agree with it or not, that culture flows north south. So I would argue that someone in Rochester, New York, across Lake Ontario, has more in common with us than he might have with his cousin in El Paso, Texas. Okay. So I think if you were to wipe out all the lines of the political map, the provinces, the states, and the countries, and you redrew North America into 6 countries, I think the countries would actually flow north-south. And by that I mean Vancouver would go along with Oregon and Washington and California. Actually, it has a name. It's called Cascadia. That would be a natural forming country given the environment, the geography, and the political leanings of the people. Okay, so I call that country one. Next would be the Midwest. You know, you go down to Alberta, down to Texas. There's and you know that theme, right? In terms of culture, cars you drive, race cars you attend, NASCAR, right? And things like that. So that would be the second sort of geographical range. The next range, Rod, would be I'd call sort of the central region. I don't know, like I'm from Toronto, grew up in Toronto. I feel very comfortable in Chicago, Great Lake City. I feel very comfortable in Indianapolis and places like that. So the point I'm making is culture flows north, south, not east, west. And because we're dealing with private people, the relationship between the two people, the investor, the joint venture partner, and the developer is important. I would say that there's kind of a East Coast culture. Like New York is just New York. It's like a separate country. There's nowhere like it. But that kind of East Coast culture sort of goes down the East Coast and so on. So we just looked at it and said, if we just start with culture, it's not our only defining criteria, but it was one things we considered is we just liked the culture in the central Midwest, in the central United States, and same time zone, same kind of weather patterns, same kind of houses, just same culture. I can't describe it any more than that. And then I'd say the culture of the maritime provinces is probably similar with, Maine and Rhode Island and things like that. So we're just talking about investing with people that understand us, that we understand. It's more important, I think, than you would typically think when you're making a joint venture decision. What is the character of the developer? Culture and character are tied together and so on. You get it. Okay. So then we said, okay, we got to look at the entire United States here, right? And so what we wanted to do was, within these, no, Rod, go. Yeah. Okay. Yeah. Yeah. So within these, let's say, north-south countries, there are 50 states in the United States. How do you do due diligence work on 50 states? It's just too hard. So first thing we thought about is what is the culture of our joint venture partners in Canada? Well, by nature, they are conservative people. They're business people, right? So we said, let's look at the United States. So we eliminated all the blue states. We eliminated all the Democratic states. Okay, so that left us with just the red states, just the red states. They're in blue here, but these are the Republican states. Okay, so we eliminated all the Democratic states, saying those are left-leaning governments. There's more regulation. There's just more hoops to jump through. We want to go to some place where the apartment developer is less fettered. Just like in Alberta, there's less regulation and stuff in Alberta. You can move faster in Alberta than you can, let's say, in Ontario or British Columbia. So all the white states there, we sort of eliminated, and then we were left with, these states, okay? And then we said, okay, so now we've got red states, but we have to eliminate some states. We have to eliminate the sparsely populated states, right? Montana, Wyoming, and so on. Those are all great places to be, but there's nobody there. That's kind of like Saskatchewan, not enough mass to build large apartment communities. And then we also eliminated the Sun Belt states, Florida, Texas, and so on, because those are very popular states. Everybody's piling in there. So if you follow what I'm saying, you eliminate the Democratic states, right? You eliminate the Sun Belt states, right? You're left with this core number of states in the middle of America in the same time zone as us, or 1 hour change, with the same culture, with the same weather, and less regulation. So we zeroed in on the Midwest here, and the place we started was the state of Indiana. The interesting thing about the state of Indiana is that the state of Indiana, the governor was Mike Pence. That was Trump's VP in his first term. Indiana is, I think, the only state in the union that's always had a balanced budget. It's a red state. Low taxes, and all the development mindset and culture that an apartment developer would like, but not overbuilt, not in one of the popular states. Everyone's going to Austin, Texas. Everyone's going to Dallas. Everyone's going to Miami and things like that. Indianapolis is a little bit off the radar screen. Now, between Indianapolis and Kentucky, between Louisville, Kentucky, which is right on the border of Indianapolis, and the city of Indiana, so it's about the same distance as Edmonton and Calgary. And the city sizes are about the same as Edmonton and Calgary, but they're the 25th and the 26th largest MSAs in the country. So they're large by Canadian standards, but kind of middle-sized by U.S. standards. So we're not going head to head with all the national apartment developers. There's good local players there in a very robust and strong economy, and I'll talk about that. So we eliminated the blue. We eliminated all the popular places. We wanted to go to red states. We eliminated the sparsely populated states, and we were left with these states. That's not enough reason just to invest, but we had to start somewhere, and this is the way we decided to sort of cut up the 50 states. All right. Now, if you look at the Midwest region of the United States, you'll see that it is the population heart of the U.S. So if you look at a heat map of where people live in North America, pretty much smack dab in the middle of that is this corridor between Indianapolis and Louisville, Kentucky. And 80% of the U.S. population is a one-day drive from Indianapolis, okay, in that corridor along I-65. And what that's meant is that a lot of the re-onshoring of industry, a lot of the warehouses and so on are along this corridor between Indianapolis and Louisville, and there's huge employment growth there. When you're building apartments, you want to go to where the jobs are, because the jobs is where the populations are and the monies are, and the renter is. So that is our thesis, okay? Why we went to Indianapolis and the reasons that we went there, right? Now, as we looked at investment returns, right? We all know that we want to be in a place where you have low apartment development and high growth. So in the chart on the left upper part of the table here, that's where you've got low apartment development and high rent growth. Okay, then we blew that up. Okay, on the bottom right hand side there, and you can see the cities that generally have lower moderate supply. The greatest danger to apartments is not recession, it's overbuilding. So we picked the areas in the cities where there was high rent growth and low apartment development. And you can see the cities there. You see Indianapolis is on that list. Okay. That's our thesis. That's why we went there. Okay. So let me summarize. So our Midwest thesis goes something like this. We wanted to be in conservative red states, and we wanted blue states bleeding into them. So Illinois, which is a blue state, bleeds into Indiana. Indiana's population is growing at the expense of Illinois. We wanted similar culture and values. We wanted a safety first clause. I'll talk about that a little bit later on in our deal. We wanted to minimize overbuilding risk. In fact, I'd probably label that as number one, right? And that's so we were looking at emerging markets. We talked about these are old cities. There's rivers, highways, airports, lots of infrastructure there to support the renewed job growth that is happening in the Midwestern United States. We also wanted to invest in efficient, simple buildings. Look, when you're the guy from out of town, you don't want to do the hairy deal on the river. Okay. You want to do a simple deal that the developers built before. And this particular deal, which we're going to show you a little bit later on, our developer built it many, many times. And we saw different versions of essentially the same product as he refined it, as he built it. You could build it in your sleep. So we liked efficient buildings, workforce housing. And really, our interest was in structuring a relationship between the developer and us. And so we want to bring together, one or two people that are like-minded investors. And in one case, rather than investing in the property, we actually bought into the developer, right? So we bought, instead of buying into the property level, we actually bought into the opco level, not the GP, in the opco itself, right? And then it's very common in the Midwestern United States to get a maximum guaranteed price, and where the cost overrun on construction would be borne by the U.S. partner, not necessarily the joint venture partner. Those are the characteristics that we looked for, and we found that in the Midwestern United States and so on. All right, Rod. So, the numbers, you can skip that one. But really, okay, hold on. So what we're really saying here is we wanted a marketplace with slow and steady growth. We didn't want to go to Texas or Florida where it's boom and bust. Okay. We wanted a marketplace where, hitting the market perfectly in timing wasn't critical. We just wanted good, steady growth. And the Midwest is delivering that, and it's delivering it in a safe format with relatively low rents. And you'll see in a minute what we're talking about here. Okay. We didn't want to be in the marketplace where the rents had to be $4 or $5 per foot to support development. We wanted to be in marketplaces where the rents were $2 to support development, right? So after we picked the market, the Midwestern United States, Indiana, Kentucky, and places like that, we had to go and we had to vet the developer. And that's the biggest job here, right? You can say, yeah, I want to be in this area. But you have to vet the developer. And so we did it sort of, I'm going to go in reverse order with number 4 first, right? So we wanted to find developers that are the full service model, development, construction, property management, and investor reporting, right? So we didn't want to get a guy who was hiring a GC, hiring a third-party manager, and so on. We wanted it to be fully integrated, right? And then, so once we found that developer, then we talked about, what's the deal? What are the returns? Show me your track record. Show me your history. That's number 3. Then, where's the deal? Because some of these developers develop across the United States. They happen to be based in the Midwest. Our thesis was we wanted a developer in the Midwest, from the Midwest, who quite frankly went to high school close to where the site is, right? We wanted that local person who understood the marketplace intuitively because they had grown up there, right? And then number 1, our key decision was who is the developer, their reputation, their experience, their character, how transparent were they in their successes, their wins, and their losses. Okay, Ron, next slide. So again, we're looking for a developer who, number 1, had a development team, a construction team, a property management team, and good investment reporting back to us. And all those things had to be in place, and they had to be functioning with a history, with a track record, with department leaders and things like that. We were looking to invest in a company that had grown from beyond the hero tentpole company, that had grown into an organization that would survive without the founder, right? Typically, these apartment development deals, when you invest at the project level, run about 4 years for the type of product we invested in. That's right from scraping the dirt right through stabilization and sale. But when we bought into actual development companies, we were making a 10, 20-year investment. So we were thinking about the team that was already in place, how that team would grow, how they would acquire more businesses to grow and things like that. It got more into mergers and acquisitions than it did the actual real estate because you're investing in the opco, right? Now, so let's go on to finding investment projects. And the best way to talk about that is to show you the deal, is to show you one of the deals that we've done here. Okay, and Rod, if you flip over to that. So this is the actual deal. This is the stage we saw it at. We saw it at the rendering stage. There was a book out on it. With about a $22 million of equity required. There's me on the site 10 days after we funded it. And the point I want to make here in that middle slide is that, in the US, in the Midwest, the regulation is minimal compared to what we face. So 10 days after the check arrived, the developer was scraping dirt. They closed the next day after the money arrived on the land. They had it under contract, and they started scraping dirt. 40 days after funding is the site on the right. So what you're looking for when you're developing money is from when you write your check to when you're stabilized. The shorter that is, the higher your return. So basically, the nuts and bolts of the deal is that you can see on the left-hand side. First off, the investors are paid an 8% preferred return on their money. Okay. Once the deal is sold, the equity is returned, the 8% is paid out back to the investor, and then there's a split of 70-30. 70 goes to the equity partner who put in most of the money, and 30 goes to the developer. That's the developer's promote. That's the developer's juice. So the way it's structured, you get all your money back, you get an 8% preferred return, and then the developer shares in any excess with you getting 70 and them getting 30, right? So from an investor standpoint, we thought the IRR was going to come in at around the 24, 25%. It actually is, I think, going to come in a little bit higher than that, but we were between 22 and 24. You never know. There's an element of risk here. The cash multiplier, if you put in $1 million, you would get 2.3 million back at the end of 4 years. There was a guaranteed maximum price contract, so you didn't have to worry about construction risk. And then the developer supplied the covenant on the construction loan. So the joint venture partner was the most he could lose would be his investment, but he wouldn't be responsible or have covenant on anything. We like this type of product, 3-story walk-up, Class A garden style, workforce multifamily housing, right? And we wanted a developer who was close to the project, and this developer is close to the project, that's vertically integrated with construction, development, property management, and investment reporting. Okay, Rod, next slide. Really, the advantages that we saw were no regulations, a landlord-friendly state, relatively early cash flows, and depending on the timing of when you made your US dollar conversion, there could be a currency hedge there for you also, but that could also go the other way. Okay, Rod, next slide. So here's the project, and we're talking here about the unit mix, 1s, 2s, and 3s. We've started lease up already. The most popular apartments are the 3-bedroom apartments, and as soon as we rented the first 10 of those, we realized, holy smoke, these are going faster than we thought. So we raised the price by $100 per unit. And in any lease up, you're actively managing the lease up, based on some sort of a revenue management formula. You can see they're large units. Average unit size is 1,149 square feet. Land is cheap. It's wood construction. You can make the unit bigger without massively increasing the costs. Yeah. So that's what we built. Here's the budget. Now you'll notice up at the top right-hand corner, we're looking at wound up being about $63 million. Price per unit, $210,000. Now these are US dollars, okay? But that is a remarkably low number because the soft cost, the development charges, the taxes, all that stuff is significantly lower. I think soft costs were 15% of the deal, and typically in a Canadian deal, soft costs are probably 30%. Soft costs is just air, right? It's not for the actual bricks and mortar that we put in. So we liked the market. We liked the cost of $210,000 per unit. Our price per square foot was that we needed to hit our pro forma was around $1.80 per square foot. That is, again, not a risky deal. So if you could get a 22% IRR with $210,000 per unit costs at $1.80 rents, that has a safety in there that we don't find in Canadian deals, and that was the attraction to it. I think I've already covered that, in going through it, but let me just show you quickly what the product looks like. It's relatively simple. There's a clubhouse, usually at the front gate, or when you first drive in down the driveway, there's a clubhouse. That's all the common area amenities. The clubhouse has the fitness center, the leasing office, the great room, the pool, and things like that. So you're looking there, at the pool, and then apartments surrounding the pool, and then going around the property. We have a total of 15 buildings here, around 24 units per building, and all the buildings are identical, and they're a mix of one, twos, and threes. So it's simple product and it's repeatable. On day one, after you scrape the ground, you put in the clubhouse in the first building and you start construction. You want to get the clubhouse coming first, and then at your leasing office, start leasing, and then over the next 1 year to 18 months, you build out the rest of the community. But while you're building, you're leasing. Unlike in a high rise where you get, all 288 units delivered all at one time, here it's phased in over a period of time, and it starts cash flowing, in I think month 14 or month 15, the first building, came on stream. Okay. So that's pretty much the investment that we've made in the U.S. We've made other investments in the actual opco. We've made similar investments in Canada, and I wanted to give you a feel for how you thought about how do you invest in the United States, how we thought about it, and the decisions that we came to. Rod, I think that's it. Were there any questions here, or otherwise we will wrap it up?
Nothing. We had one gentleman. Alborz. I just recommend reach out to Dave Price, and I'll
Yeah.
put Dave's slide back up here so you can see that on screen. But oops, sorry, we're just going to the wrong slide. There we go. And that would be the best answer, because that's more of a personal question, and rather than
Yeah,
for the whole
yeah, yeah,
audience.
yeah. Well, what we wanted to show you here was that there's a methodology to vet a marketplace, and there's a methodology to vet a developer. And really, the real takeaway for you is that at the end of the day, you are investing in the developer, and what that means is the developer's character, right? And the only way to do that is to spend time at the property with the developer, with his team to see the culture of the company. All right. Thank you very much. Wish you all a good day.